hear me okay?
Yeah.
Thank you so much for having me here. It's really lovely to be here. So just a little bit about what we do at my, I guess maybe I should trace all the way back from how I came to the States and how I got into finance. So I actually came to US to attend Middlebury College in 96. So I graduated in 2000 and just came straight to New York to start my career. And I was in finance day one. But it took me a year to realize my first job, which was an investment banking analyst at Credit Suisse, was not what I wanted. I found the banking job to be a little bit too marketing driven and too sort of sales driven, and I wanted to do something that's more sort of intellectual, analytical. And that's the reason that I switched from Credit Suisse to fiduciary trust. And then I went back to a business school to get my MBA degree. I went to Korea for 2 years, and after I came out, I joined a startup hedge fund, which was a spin-off from SAC, the largest hedge fund in the industry, and worked there for 4 years. And it was in the hedge fund experience. It was the hedge fund experience that kind of really piqued my interest in investment management. And we were very much a quintessential sort of a bottom-up investigative research shop. We utilize heavy channel checks and speaking to everyone on the supply chain to understand the products, the services, and everything about the company. We wanted to invest in long and short. A lot of people think hedge funds are just sort of moving paper from one place to the other. It doesn't really add value to the economy or to the society. To a degree, I disagree. Obviously, I'm in the business, and my current job is to help money managers and a lot of them hedge funds to create higher return for their investors. I think in investments, every time when you long or short a stock, index, ETF, whichever, bonds and fixed income products, every time you make an investment, in a way you're expressing your view, whether you think that this business will succeed or fail. And it's through your vote collectively, the market decides the capital allocation and the reallocation. And I think the investment community adds value in that way. A lot of businesses are, kind of in a secular downturn and poorly run and doesn't create value. They deserve to go bankrupt, to go belly up and disappear. So the process and the investment of shorting them accelerate the speed of that. And I think that makes sense. So while at Orion, where I worked for 4 years, I encountered the emergence of China-based companies coming to the U.S. to list here to raise money from U.S. investors. And what I found was from the macro level, the China economy itself has been very hard to read because of either the lack of accurate data or the processing technology, or intentional, unintentional, just sort of opacity of information. And on the micro level, there's sort of a corporate governance issue. And I think one of the biggest myths about China, about investing in China, is that a lot of times people confuse GDP with what's really matters for the minority shareholders. GDP is a description of the size of the activity in the economy. It doesn't translate directly into earnings. It obviously doesn't translate into earnings distributable to shareholders, let alone minority shareholders. So in the case of China, and it's applicable to, what I'm going to say is applicable to all economies, all, whether American companies, European companies, Japanese companies. By the way, Japanese companies probably is the worst group of, from an investment perspective, we are even worse in corporate governance than Chinese managements. But what I'm trying to say is people kind of don't really people, like to jump in their logic in a sort of concluding because economy is growing, double digits for the past however years, pretty phenomenal. Therefore, making an investment in Chinese companies will, achieve high return. That's completely wrong concept, and whoever practiced that obviously get burned very badly over the past few years. So, I think that's something people need to think about. Chinese, the whole China story, in essence, is actually pretty simple to explain. It's an economy that has been hugely successful over the past 30 plus years on a heavy fixed asset investment model, largely led by government and the government related SOEs, and then secondarily export. And that manufacturing focused, the fixed asset investment focused model has run to the end of the life for a very simple reason, because of the cost structure has shifted up, not cyclically, but structurally. Labor wages are no longer cheap. Commodities, whether it's hard or soft commodities, are no longer cheap. So therefore, the margins, if you look at the companies, a lot of their margins have been declining for a while, and some of them negative. So, SOE companies, when you read about SOE financials, and if you realize they're not making money, that's pretty common. So then, what they're trying to do is try to switch out of this government-led model and to a more service-oriented and consumption-oriented model. But that requires a different set of software, requires more innovative thinking, more sort of a creative labor force, and that has been and it requires SOE, deprioritizing SOE, the state-owned enterprises, their roles in the economy, since they're more bureaucratic and less efficiently run, and creates worth as opposed to creating value at this stage of economic development. And that has been sort of facing a lot of challenges and a lot of techniques, and we can go into that a little bit more in details later. So through this observation, the disconnect between the state of the economy and people's perception of China, I decided to come out and run my own business. I was talking to some of the members earlier, and people asked me sort of what gave me the courage to do so. I think one thing that's important thing that I actually would like to share with you is I think number one, I've been working finance for a pretty long time, so I don't really have the sort of a financial, I'm financially pretty well equipped. So to allow me to try different things and to, to sort of do a little bit more innovative moves in my own career. On the other hand, I know my business model pretty well. So I know if the work is done right, it creates such a huge value to clients who are the investors, institutional investors. So, the leverage is very high, and my business margins are pretty sustainable, and it's a pretty good, business model. So, and I've been in the business long enough, so I have enough network, and it's not hard to find an initial group of clients. And once I have a few initial clients, it's break even. So it's not like I started a telecom company which requires initial sort of overhead investments of tens and thousands of millions to get it going. So it's a rather asset light but high margin business. That's all based on the assumption that the work is value adding, it's real time high frequency, and provides data sets and the intelligence that's not readily in the marketplace. Otherwise, the margin will not sustainable. And I don't compete us competing with the mainstream Bulge, Brackets, Bigs, and their research arms of that. I think those houses have nowadays faced so high compliance hurdle that there's so much work that they cannot do, and they're so slow moving, and the methodology just wouldn't work in China, because what we want to capture is high frequency data points. Real estate today in China is certainly different from where it was last year very, very different from what it was a few years ago. I started my business in 2010. I have been running for about 4 years. It took me 2 years to find the right infrastructure, meaning the people who can help me to run around and get information in China, whether it's the housing sectors, the Macau casinos, the VIP rooms, and the people who work on the mass floor, so that we have the report of weekly traffic and what's the activity level in those casino companies and the auto sector. By the way, we are a China-focused research firm, but doesn't mean that we only cover Chinese companies. We also cover any multinationals with high exposure to China. So that includes a lot of German auto companies, BMW, Tesla to a degree. And we've done lots of work on the Swiss watch, which soared in their sales in China between 2010 and 2013 because of the corruption economy and mistrust economy. So I talked about housing sector, auto, casino, and we do internet. We do a little bit e-commerce as well. A lot of internet models come from U.S. comparables. So you have TrueCar in the U.S., you have the Auto Home in China, and you have Redfin in the U.S. You have Sofa in eHouse and the Luochi in China. So we observe the track record of those U.S. companies and understand the nuance in difference between the U.S. comparables and the commercial reality, how the U.S. commercial environment, demand supply, different from the Chinese environment. Typically, the Chinese environment is more fiercely competitive because once you have I can't really explain why, but my observation is just people in business are much more aggressive. Probably it's because it's a 1.2 billion populated country. So, to get ahead, you have to be extra sort of proactive and aggressive, and sometimes you're willing to, achieve profits or personal gain at the cost of quality, and that's the problem. Because that compromises sustainability of your profits. So, and then we do anything that we call event-driven, which is anything that we sense that there's a significant delta, meaning difference in between the reality and our reality check. Between reality and the perception. We jump into this. One example is Young Brands. So Young Brands, everyone knows about it. And 50% of Young Brands' corporate group revenue profits actually come from China. Some of you might not know, but U.S. investors love the stock because they think that's a perfect play on the rising middle class. So as China gets richer, income level gets closer to the U.S. By no means very close, but sort of when the gap narrows. Chinese consumers will repeat the pattern that has been seen on the U.S. consumers. It happened, but it's kind of a stagnant plateau. The reason is they're very similar. Fast food concept, the chain caught up, and a lot of them came from surrounding Asian countries. And at the end of the day, Chinese consumers prefer they enjoy the Asian themed or sort of the similar Chinese themed fast food restaurants better than the fried chicken. But it took a while. Still, I think Young stock is very interesting. Over the past 6 months, the stock jumped because of activists sort of taking position in the company, and they came down because of running the devaluation. But I still think in terms of the underlying business, the US investors, or global investors for that matter, don't fully understand that the peak story in China is already gone. On top of that, the X factors of doing business, meaning anything that's sort of out of the control of the management, out of the control of executives and the company's strategy, is so much greater in China than in the US. Say, for example, the equivalent of FDA they sneak into the kitchen and test everything about test the hygiene on the uniform, need, in the kitchen equipment, and the findings are always kind of disappointing. Food hygiene is a pretty, it's a pretty prevalent issue in China. But when consumers pay a premium, the fried chicken made by KFC is still of a premium compared to the average fried chicken in China. So when people pay a premium to go to American fast food, they expect better quality. They expect better hygiene and more pleasant environment, and then that's kind of falling short of their expectation. They stop going. And today's reality is social media plays such a big role in spreading the news. So when one kitchen is found, found any bad behavior, say in Shanghai, T3 cities, T4 cities, people living in rural area, and in small countries, they stop going to KFC. So, I mean, what happens is since 2012, if you look at the KFC China performance, it's been very choppy. To date, its sales level has not been normalized to a 2012 level. And if you look at the stock, it still trades as if it's a growth story. It's not. I mean, a lot of people argue, Taco Bell in the US, but it's like 4 or 5% grower. I mean, I don't know, how much you're willing to pay for that much growth. So my point, the KFC is just one example, right? I mean, BMW, the same thing. 45% of the EBITDA profits coming from China. So effectively, the Chinese market grows. How many high-end cars it sells in China besides the stock performance? Same thing with Rolex. Same thing with all the luxury Swiss watchmakers and the LV bags to a degree as well. And that's one of the reasons that we got interested in the casinos, because we think the activity level and the money in the Macau revenue has been elevated. And it's not sustainable because the reason behind the elevation was number one, the corruption outings, number two, money laundering. And when the central government in Beijing tightens the scrutiny of both, Macau has been slumped over the past 12 months. To date, we don't see any obvious pickup, and there's certainly no positive news flow from my end. So I still have a few minutes.
Do you want to do questions? Just also random questions.
Okay. I just want to summarize a little bit. I think so. I talked about one misconception when people look at investing in China, which is how GDP is not correlated with the earnings distributable to you and to me. And the other thing I want to emphasize is I'm in the world of I do stocks for a living, right? So when I look at stocks, it's different from looking at companies. We are not company analysts. Underlying business is very important, but when it comes to stocks, you have to keep in mind all the time that you are comparing what's the consensus and what you believe the stock is. The consensus of iPhone is, I actually don't know because I don't follow Apple. The consensus of iPhone, say for example, is i6s will be equally successful as 6. And if you run around the supply chain in Taiwan, in China, and you realize it's actually not the case, or if you talk to the key markets, which is the US, Europe, and China, you realize the upgrade cycle is going to take a while. I mean, people who already bought 6 are probably not going to get 6S, and this touch screen, the innovation, the touch screen or the camera heads isn't significant. Then you find the edge in a stock, and you only get involved in a stock if you are convinced that you have a significant amount of edge, which is differentiate the view on a stock, and your edge is correct. That's vague. Otherwise, I just don't believe you should own or long. You should invest. I think investing is very labor consuming, and especially the way we do, and there are certainly different ways of making money. But the way we do, which is very much company specific and just bottom up, when we do, at one point of time we were investor of Garmin, which makes a GPS. And I was in a Best Buy. At that time, there's still Best Buy. People still went there. That was 5 years ago. I was there every weekend, and just kind of like eavesdrop, like just listening to what consumers talk about, and chatting with salespeople on the floor. So that's the way I developed my edge. And your way can be different. I mean, it can be from academic research. It can be talking to policymakers if you have that kind of access. But till you have the edge, I just don't think. I think losing money, not losing money is a lot better than losing money. Not losing money is more important than making money. So in that sense, I think people should be conservative. They should spend the time. And if you don't have the time, I think you should just invest in index, unless you are wealthy enough to be a qualified investor in well-run hedge funds. And I think not all hedge funds are equally viewed. Some of them are really, really smart people doing lots of work and working extremely hard and try to deliver high return for their high net worth individuals. And I believe in those managers. Some of my clients are those managers. But a lot of them are not so well, and a lot of them are just lever the loans, but they charge people to 20% hedge fund fees, which I think is rip off. Yeah, so that's kind of my views. So, if any questions, I can take them now.
You mentioned the effort by the Chinese government to shift the economy to more of a consumer-driven economy. Are there any themes that you're seeing really at the company level where the best opportunities are as that unfolds? I mean, are they companies that are geared more towards the rural markets? Are they companies geared more towards younger people? Any themes that you see there as that plays out?
I think there are definitely concepts and activities in the company's business you can invest in. You can invest in there are private ones and there are public ones. I generally say to people, travel is still big. People certainly work a lot more and they feel a lot more stressed than the Golden Week, which is coming up in a few weeks. So October 1st is a big long weekend. Big long week holiday, national holiday, and then Chinese New Year, right? You observe the pattern how people spend their holidays, how people spend their money. Travel, people try to either go to other parts of China or outbound travel. And because of currency, Japanese yen, as you know, has been depreciating by a lot over the past few years, and renminbi is effectively pegged to US dollar, so has been going very strong. So you see Chinese people going to Japan a lot. And people, Chinese people still, like luxury stuff. So they would travel to London, to New York to buy, expensive stuff because it's cheaper there. Korea, yeah. So I think the leisure travel is very good. But translating to companies, which companies you want to invest, you have to be very careful. We looked at some sort of a mid-level hotel chains in China. 50% of the business is leisure travel, 50% of the business travel. While leisure has been pretty good and going up, business travel has been down a lot because the anti-corruption campaign has been ongoing for 3 years now. And that kind of just totally changed the dynamics of doing business. The inbound travel to Beijing has been killed. Don't do work is a lot safer than doing work because you don't want to catch the central government attention. If you are local government, you're deciding if you should build an airport or not. But you the better it's much safer to lay low and just don't do anything. Just wait till this thing get passed, but it doesn't look it's going to get passed anytime soon because it's becoming a new norm. Right? And then part of the anti-corruption is just build some credential for Xi Jinping. Part of clearly it's a political cleansing. It's to get rid of the enemies So you don't want to stand out. You don't want to be seen. You don't want to be visible. So that's why Audi sales in China declined a lot. Because Audi has been, over the past, the government car, people drive Audi to hotels and they can get good service because people, the Belgians assume that they're government affiliated people, or government officials or something. But now, you don't want to buy Audi, buy something else. Yeah. And then the healthcare service related, not like investing or building a hospital. I think one thing the current government should do in this sort of, as we see China starting into recession, I think City chief economist came out with a report last week, and he's projecting, middle of next year, China will be officially in the recession zone, defined to be by over capacity. So your capacity of producing your actually production level. And one way, monetary policy has been expansionary for the past 16 months. So the marginal utility from monetary policy has been declining. Maybe you will do some fiscal stimulus, but it's very constraining in a sense that the government doesn't want to create sort of the bubble it created in the fixed asset investment in 2009 to fend off the U.S. Mortgage crisis that were the recession. I think one thing government could do is to give vouchers to consumer to buy healthcare and education services. So once those services are in place, it will perpetuate itself and perhaps create new industry and new growth for the economy versus just spend money upfront to build more hospitals and more. Those are more like a one-time. It's not going to generate sustainable, recurring, consumer-driven spending. So healthcare, especially woman-related, childbirth-related healthcare has been doing well because so much effort, so much focus in China as a society is on the younger generation and how to bring them up better than their parents' childhood. So I think anything relating to education, perhaps private education. But then, I'm just talking about the big picture. You still have to do work to zoom them in and to find individual companies, not just companies, but also stocks, and to identify what's not priced in, right? The fact that we're talking about this, and we already, so many ideas, the chances, the market already, ahead of us, and so much of it's already baked in. So you have to find something that's under the radar. People haven't really, a hidden gem type of situation. Yeah.
You mentioned corporate governance. Would you compare and contrast corporate governance in China to Japan and also to the U.S. just so that we can better understand that?
I think U.S. stock market and SEC, the regulators and regulations has been in place since now it's been like 100 years, right? I don't know the U.S. security history very well, but I know the stock market. I've studied the stock market performance and the return since Great Depression, so it's been there for a very, very long time, and it's relatively more mature, less loopholes, just because era and amendments and trial and error process. It's a natural process. So, but in China, the market economy, sort of a semi-market economy, stock market has only been here for like 20 plus years. So it's still trying to catch up. So are the regulators. So are the regulations. So disclosure is one thing. And honesty is the other big issue. I don't know how many of you paid attention to the front page article on Alibaba, which is the largest e-commerce company in China, and led by this very charismatic Jack Ma, who I think Americans love it because I heard great things about investors loving him. He's a great salesperson. He's always ready to sell you ideas and stock. And great English, so that gives him one edge over other Chinese management who oftentimes barely speak any English. So, and they're listed here. So, I mean, I think the one angle of the article, and then 2 days later, Alibaba actually refuted the article by publishing its own version of what they think is the truth and what's being the false accusation article. But one thing Alibaba didn't review is when very high level executives borrow the money from the company to buy another company, borrow the money from Alibaba to buy another company without clear explanation of reason why and whether it's for personal or it's for. So that's the issue relating to governance, right? The disclosure. I mean, I think there are corporate governance companies everywhere, whether it's European. European certainly worse than US. US is the best in the world in terms of transparency. Because, I mean, you guys know one of the problems America has is it's no longer rule of law, it's a rule of lawyers. I mean, so anything happens, the first thing you do is litigation system is so active. So, I mean, you don't want to, I mean, companies know how to sort of behave, sort of proactively, sort of defensively behave better when approaching dealing with investors. So Europeans, I mean, like we studied a Swiss Swatch Group and the Richemont, which is owner of Cartier. Their disclosure is very poor too. I mean, related party transactions. You know, I borrow money from you. Perhaps the CEO would borrow money from a supplier, perhaps to buy his own house or something. That happens. In China, of course, it's a lot worse. I mean, one example, very interesting, is that I am a friend with the CFO of a company that now is no longer existing. But he was the CFO. It's a public company. It's traded on Nasdaq, and one day he got a call from investors and asking why stock declined so much, and he realized it was because his CEO, his boss, the CEO, actually used the company's stock to for mortgage for his own house, and he got a margin call. So yeah, and that's one of the reasons, other than the business not performing poorly. That was one of the reasons the company now no longer exists. I actually, frankly, don't know whether it's still running around. The other thing about Chinese companies, especially those China-based, the US listed, is the loophole is very great because this phenomenon is very new for both SEC and CSE, the regulator, the Chinese SEC. And those are China-based companies, and the management being Chinese nationals. And if there's irregular behaviors, SEC wants to punish them, there's effectively no way, right? Because, I mean, as a registered business in China, you need to go by the law in China. But your security is floating here. You should be responsible for the U.S. investors, and there's no sort of integrated. The two sets of laws currently are not talking. So that's why you see a lot of companies cheated on the U.S. investors and burned them, and and still okay. I mean, they are delisted, but the business is still running in China, and they still have large amount of wealth in hand and not being published. That happens quite a few times. I mean, I think that's why SEC becomes a lot more sort of alert to a situation like this, but there's no fundamental solution to it. I mean, I think one thing SEC could do is perhaps ask companies of this nature, foreign-based U.S.-based companies, to remove the risk factors and just flash them on the front page of prospectus. But how many investors do you actually know read the prospectus? So I mean, it's like it's like buyers beware, and it's I mean, if you're willing to be misled, I mean, all comes back to the importance of doing your homework. You need to know what you buy into, and you need to know, you need to know that you've actually done enough work, exhaustive work. I mean, otherwise, just put all the money in index. I mean, just believe that U.S. economy fundamentally on a relative scale is still in good shape, and that over the time the problem will get solved. I mean, it's a little bit, I know, leap of faith, but the rest of the world has bigger problems.
I've been in the business for a long time, and when I started out, the business as measured by either people taking the CFA exam or people who were members of the CFA Institute was 80% men and 20% women. And now, all these years later, and I'm talking decades now, we are still at 80% men and 20% women. It's a staggering thought. So, and especially when you look at some other professions, accountants, lawyers, doctors, where we're close to 50-50 in some of those other professions. So as you travel and you interact with a lot of different financial professionals, do you see that women either act differently? Do they need to be a little bit more aggressive, like you were talking about in China? You might need to be more aggressive. Are there any places where you see women gaining ground? Certainly, I wouldn't expect in the hedge fund industry, but maybe in private wealth, or I mean, and I know you have a global view, but probably oriented towards institutional investors. It's a long question, but mostly women here, and it's really so refreshing.
I mean, I think that this is absolutely a significant question, but I kind of don't share the consensus that, Sheryl Sandberg wrote a book in, but I really think it's more a personal choice than anything else. I think women certainly have, a lot of them have preset different set of priorities, and that's completely great. There's no talk about, woman's body is naturally, biologically, chemically wired different from the man's. Therefore, in approaching career, approaching domestic tasks, we are different. So I think recognizing the difference, and I think more importantly, recognizing what works for you as an individual, is a lot more important than just trying to sort of understanding why it is the way it is. It is the way because a lot of women choose. It is this way because a lot of women choose to take a bigger role in a household and try. A lot of women. My sister is completely different from me. She doesn't work, but her days are not easier than me at all. She's raising a 4 years old, and I'm actually dealing with rational human being, and she's. So I don't know whose work is more. Whose work is more. Her work is absolutely important, right? Raising a child and. And she chooses not to work, and she's perfectly happy. But if you are not working and you are unhappy, and you think you define your personal success as, a career success needs to play a significant role in your personal success, I think then you have to behave differently. You have to, like you said, be more assertive and be more aggressive and trying to find your place in the workplace. And just because the 20 and the 80%. Is to a large degree driven by women's own decision. So I think for the 20%, if they wanted to gain, more responsibilities and achieve more, they have to sort of, do an extra bit more. I think China in that sense is very similar to the US. I think a woman attain equal level of education. It's not Japan, it's not India, where you could argue 50% of the population is not fully utilized in sort of the labor force, sort of in direct sense to the economy. Although you can argue domestic production is also contributing to the well-being of the entire official economy. But I think I've seen lots of women in managements. It is true. I haven't seen a lot of women in hedge funds world. Partially because it could be that women don't like to make decisions. I've seen great amount of women being like CFOs, probably fewer being CEO. But I think it could be possible. Just we have a different set of skill sets and the different enjoyment and different likes. And I mean, I think it's just so individual based.
I have a question about just kind of how we should be thinking about the Chinese economy. You mentioned that the sort of the fee for the payday is probably behind us. Should we be thinking about the current slowdown in the economy and activity as more of a sort of business cycle problem, or do you see it more as a structural issue after arguably years of unproductive, inefficient, fixed investment? And I'm going to kind of tack on the second question, which now I feel like runs the risk of being cured by policies or stimulus more of the same, kind of like waking up with a hangover and taking a shot, to cure the hangover. I mean, it kind of like what was announced last week kind of reminds me, okay, here we go, more infrastructure investment. So I mean, how would you recommend we kind of view the current situation in a broader manner?
I think it's exactly right. I mean, a lot of people say this time is different from 2008 in a sense. This time, the crisis or the recession is domestically led, versus 2008 it was more like U.S.-driven, developed markets led. And a lot of people make the argument that as China slides into a recession in 2016, the world is going to face slowdown, and this time it's going to be developed markets led. And everything gets more complicated because of the renminbi devaluation. Second half of in August, and then that drives the competitive devaluation around the neighboring countries. I think that what they could have done is, in 2008, instead of doing this 4 trillion fiscal stimulus, which is largely into the highways, no one today drives on, or airports, very few people go to in rural area, and a massive amount of construction of in the housing sector. I think they should have just let sort of the natural slowdown play out and just kind of use the U.S. as an excuse, and let it naturally play out. But they didn't do it, and they were very successful in fending off the slowdown. And then, in fact, everything kind of double-digit growth got revived. But this time, like I said, fiscal policy hasn't been. There's only this many airports you can use. I mean, what occurred last time is one thing I didn't mention is the debt problem. You 4 trillion and 4 trillion spending, and then those are all banking of bank borrowing. A lot of the products, most of them are non-productive. When you think about this, if they are profitable products, private sectors would have already gone in and do those. They didn't need a recession to trigger the investment binge. Because it's by nature hardly profitable, the government had to take on those projects in the time of crisis to revive, in the name of reviving the economy. And the debt problem is one of the key issues for China. And in a sense, one thing is people should notice is that in itself is not an issue as long as the debt service ability keeps going up as well. But you have a structural, your question is whether it's structural or it's cyclical. My assessment is more structural, but you never know why. Because since the open and the reform and the private sector started to play a role in the economy, it's only been 30 plus years. And since then, we haven't seen a complete cycle yet. Everything has been up. We're talking about 7%, reported number as a recession, right? So we haven't seen a complete cycle, and that's why value investing is not really applicable in China, because value investing, first thing you look at is what's the normalized earning, right? There's no normalized, because there's no normalized meaning you weather through all cycle and you take the average. We don't have that. Until, right now the situation is you have this humongous bubble in the private sectors, in banks, not so much in public sector. Central government is still relatively in good shape. On top of that, you have this, sort of the broken economic model. Manufacturing is no longer competitive, right? They all moved to, from China to Vietnam, to Cambodia, to et cetera, because the wage has increased so much. So next, you have to find a new bright spot to replace the exports, to replace But then every time you have in anywhere in the world, in president cases, every time you have economic major restructure, recession is inevitable. But what Beijing trying to do is to delay and pray, just kick the can down the road, and I think it learned from the U.S. pretty well. Obviously Europe too. So it's still try to like you read last week, still trying to repeat the same path. So I think at the end of the day, ultimate question is it possible to have sort of market force driven economy with this one party political system? And is it possible to have this open economy where you tolerate volatility and the flexibility and the sort of market driven dynamics, meantime maintain this sort of very high level command control based political dynamics and the societal order. So, I mean, I'm not a sort of economic historian, but my gut feeling, I'm more leaning towards, I think it's quite impossible. People like to use Singapore as an example to counterprove that because it's also authoritarian. And then meanwhile it's prosperous, but Singapore is, I don't know, the size of New Jersey versus China is 1.2 billion, so it's not really comparable. Yeah.
One more question.
When do you think the Chinese recession will bottom? You think maybe next year will be the bottom of the economy, or do you think it'll be more prolonged? And then based on that, when would you expect to increase exposure to commodities or other more industrial sectors exposure there?
I mean, I think that question is really open-ended. I mean, I think what I can say is, a lot of it, most of it depends on the politics and how government reacts to not only domestic issues but also international dynamics and how it manages the transition from its claim, the sort of a transition from SOE dominant economy to a private sector dominant, from investment driven to consumption driven, from manufacturing driven to services driven. But I think what I can say now is, there's no visibility, and it seems like they're repeating what they've been doing in the past. And they're still going back every time there's a slowdown. They're going back to the old path of success and trying to copy the policy tools that they used before, such as, a lot of people argue that the depreciation per unit in August was intended to stimulate export, even though they try to deprioritize export as a component of the growth engine. But every time when there's a slowdown, you just got to do whatever you have to make it going, so that they want to maintain some legitimacy of the leadership. And face is very important for those people, and I think I currently don't see the transition. I think it will come. Even assume victory is the end. The victory is the end path, but the way you get to that is going to be very volatile. So I can't really predict that. I read some reports by some major investment banks, very reputable global economists. I think they're talking about maybe 2 years recession starting from the middle of 2016.
Thank you.